Welcome, audience. Episode 9 of Tropic Trading. We haven't talked to you guys since around the beginning of April. Just wanted to get the channel going again and talk about the economy since April 2nd. And James is going to go over some Roth IRA, traditional IRA information. So, since S&P 500 and the NASDAQ, they advanced Wednesday, rising 0.5%, 0.8% respectively. So right now the S&P 500 is closing a new record high, guys. Just think about that. Think of the swing we had. I think we're at one point we were 25 to 29% down from all-time highs, and now we swung just back up to all-time highs just recently.
Yeah, people were freaking out last time. Like the last episode when we met, people were kind of freaking out because the market was crashing. Nobody knew what was going to happen. People were like selling out of the market. They thought Trump was going to ruin everything. But what actually ended up happening was, so Liberation Day was on April 2nd, right? The market bottomed on April 7th. The NASDAQ was down 25%. And that was peak fear. But what did we say in the last podcast? We were saying this is a buying opportunity. We're literally at the levels of the 2021 highs. This is like the perfect time to jump in. And what do you know? What happened? Over the last couple of months, the market continued to rally, and now we're at all-time highs again.
All-time highs, guys. I mean, a 25% market rally, and to James's point, like if you were to make a 10% gain in the stock market, that's huge. But we're talking about a 25% gain, and it gave you guys the confidence to go in and still trade, even with all that uncertainty in the market, with tariffs, Trump getting in. And so it just speaks volumes about the vision of how can we anticipate the market and not letting fear override your logical thought processes of getting into the market.
Yeah, exactly. I mean, you want to take these dips as an opportunity to buy the dip and get in at a lower price. I mean, I saw something like people are going crazy over these Amazon liquidation stores. They like line up around the corner to buy all these products on sale. But when the market is going down, the stock market's going down, you can buy stocks on sale. So if you're gonna go buy beauty products and vacuum cleaners on sale, and you think it's a great deal, why don't you think stocks are a great deal when they're down 10 to 25%? I mean, come on. So and by the way, when things go back up to the same position they were originally, it's a higher percent gain on the way back up than it is on the way down. There's a famous quote by Ray Dalio. He says, if you lose 50% in the market, you have to make 100% to get it back. So it's always bigger on the way up. So when this market tanked, so I just wrote down here. So the peak of the market before Liberation Day was February 19th. Okay, from the high on February 19th, NASDAQ high, to the low on April 7th, that was a minus 25% loss. So your account in the NASDAQ would have decreased by 25%. But if you bought on that same day on the bottom on April 7th and rode it back up to today, we're all-time highs again, you would have made 37%. So 25% loss on the way down, 37% gain on the way up. That's why it's just so important to identify these opportunities when they happen. When you see massive panic in the market, that's when you want to go in hard.
Yeah, it's like you said, April 7th, April 8th, the S&P 500 was sitting at 49.75. It's currently sitting at 62.31. So it's definitely an opportunity to cash in on people's fears, and and you know what's interesting? Payroll numbers, they unexpectedly fell by 33,000 in June, and we're still sitting at all-time highs in S&P 500.
Yeah. Well, probably why that may be is because the market gets excited when it thinks interest rates may go lower, and if unemployment ticks up, that's actually good news for interest rates coming down, because the Fed is more likely to lower cut interest rates even by a little bit if they see employment numbers go down. And I think that's what the Fed's Jerome Powell said that they were going to do, was at the first sign of bad unemployment numbers, they will make the next rate cut. So there's still, I think, like a 20% chance of rate cut in July. So I don't know, I'm hoping that happens. But if not, it's looking like it's going to be a sure thing by September.
Yeah, and to James's point, the number one stimulating thing for the economy is a rate cut, interest rate cut. That's stocks automatically go up. Companies will take on more debt, be more aggressive in their project. Future forecasting for hiring. They'll say, hey, if the interest rates are low, let's spend more right now, but when they're lower, then we're going to have to hire more people and get the projects rolling in that way.
So businesses can take on debt to make more investments in their business, and consumers can take on debt to purchase more products like cars or what have you. There's like debt for everything now. That big festival, Coachella, I heard something, I mean, don't quote me on this exact number, but it was some crazy number, like almost half of all the attendees to the music festival used buy now, pay later programs to purchase their ticket. It's like a few $1,000s, I think, the ticket.
Yeah. So to James's, so everything's like a debt instrument now, and it's like even a car, it's like people buying refrigerators, you go into debt. It's a payment schedule. A mattress. My brother was in debt to a mattress. He was making monthly payments on it. So,
which is that kind of ironic about the Coachella thing, because Bernie Sanders showed up at Coachella to talk his usual smack about the big banks and oligarchy and all that stuff. It was just kind of ironic that like half the people financed through the big banks their ticket, but I digress.
So without the big banks, they wouldn't have gotten to, they wouldn't be able to attend the music festival. So,
oh man.
So to your point, and that kind of leads to the national debt. It's Trump just added $3.4 trillion to the national debt. So, it's kind of an oxymoron. You say to yourself, wait, I can't be in debt, but then the government can be 37 plus trillion in debt. So on the back end, you're actually paying for the nation's debt. But even though you're saying, individually I'm not in debt, I think on the back end you're still paying for the nation's debt.
Yeah,
which is
no, for sure. And I think that's what that sort of feud between Elon Musk and Donald Trump, to get back into politics with that. The last time we were talking, they were buddy, and now Elon doesn't like the fact that this bill that Trump is passing has a lot of spending in it, and I think most people probably don't like that either. But I'm kind of realizing it's like, it doesn't matter like what side of the aisle you're on politically. These larger bills that get passed, they always have all this other stuff baked into it, and you try to minimize it as much as you can. But it's like, unfortunately, I guess politicians have a list of favors that are owed, a list of things that they all need on both sides.
Yeah,
it's really crazy. That's a whole nother podcast. But I guess the name of the game is we just try to do the best we can to get stuff passed that's going to help people. And like, they had to extend these tax cuts, or else if they didn't extend the tax cuts, then everyone's taxes would have went up by a lot. So it sort of is what it is. But I mean, I haven't dove into it yet, all the details. Maybe we can do an episode on that, about this big beautiful bill they're calling it, and how it's going to affect your finances. So far, I know the big thing is that they're just going to make those tax cuts permanent that were effective 2018 in the Tax Cuts and Jobs Act. They're going to make that permanent. So that's a good thing, because we were all going to be screwed if not.
Yeah, so that's the kind of high level of what's going to happen. We're going to get into more details in that bill, because it's definitely a forward-looking indicator of how the economy is going to play out.
Yeah, maybe that'll be the next episode. We can talk about that.
Yeah. So kind of more concrete, we're going to lead with Roth IRAs, traditional IRAs, and James is going to bring up some good points about, when to invest in which and what circumstances would be beneficial for you as an investor. Kind of some nuances about, the limits of how much you can invest in a Roth IRA or individual or traditional IRA.
Yeah. So all this good news with the market rebounding, and most people are probably wondering, well, like how can I get in on that? How can I, what type of account do I need to open up? And I mean, you have really first of all, you have two choices. You want to answer this question first. Do you want this to be retirement account or non-retirement account? And my answer should be both. You should have both, because a lot of investing is for the long term. And when you're really thinking long term, you also want to think about building your nest egg for retirement. And there's some great tools that are available for you to do that, such as the IRA. And we can talk about the two different IRAs there.
Yeah.
Also your 401k from your workplace investing. But besides retirement, there's also non-retirement, which they call it's just called a brokerage account. That's just an account that you can trade stocks in, and there's many different companies that offer it: Robinhood, Fidelity, Webull. I don't know why I said Robinhood first, but I wouldn't. Yeah, but there's a few good options out there. I would check into Fidelity, Webull first. There's actually a new one that I might check out soon called Ninja Trader.
Oh, really?
And it's like it's almost like they kind of it's really cool. They allow you to almost like in a gamify way. You can like on the screen grab your stop loss line and drag it up as the trade moves up. Then grab your limit order and move it up. So it's almost like you can have a lot more control over that game, over the trade. Maybe that's why they call it Ninja Trader.
Yeah.
Where they really make it like a video game, and I mean that'll definitely give you an edge on the market for sure. So I think I might check that out. But anyway, the main difference between non-retirement and retirement accounts and brokerage versus Roth traditional, it's really all for tax purposes. Unfortunately, we have in this country really convoluted tax structure system, and you got to try to pick the right account, and everyone's got to find their own personal loopholes to pay as little taxes as possible. It's just the way it is. But quick rundown: the most basic account, brokerage account, non-retirement.
Yeah.
It's just you put money in just like any other account. You can put it in, take it out whenever you want, as much as you want, and they're going to tax you anytime you make a gain. So anytime you sell something and there's a profit, you will get taxed on that at the end of the year. Or if there's a loss, it will go against those profits, and that's for every single trade. So on every trade you make, they add up all the gains at the end of the year, get taxed. Versus in your retirement account. These accounts, IRAs, 401ks, they're what we call tax deferred accounts, meaning you don't get taxed from every single trade you make. You actually don't get taxed until you take the money out, and that's down the line when you're over age 59 and a half. Or if you have a Roth IRA, you actually won't pay any taxes when you take it out. Now, there's benefits to. So we talked about non-retirement brokerage account. You put money in, you get taxed on every trade at the end of the year. Retirement, there's two different ways to look at this. There's pre-tax money and there's post-tax money. Pre-tax money is money that hasn't been taxed yet, like with a 401k. When you contribute to your 401k, when your company contributes, that money does not get counted towards your taxable income. So it's considered pre-tax. You never pay tax on it. You will, however, pay taxes when you're old and retired and you withdraw that money. An IRA stands for individual retirement account. It's not through your work like 401k. It's your own personal account. And this is key, guys. This is what I think everybody should have, is their own IRA. And you can, through changing jobs, you'll have this 401k, that 401k. What you should be doing is every time you change jobs, you roll that money from your work's 401k into your personal IRA. So your IRA stays with you, your 401k changes with your job. And that's what I have. I have a traditional IRA and a Roth IRA, because the traditional IRA is where you put your pre-tax money. So any money that your employer contributed, or that that you contributed in normal contributions, where you get a tax deduction or it doesn't get taxed, that is all going to roll into your traditional IRA. And then Roth IRA, that big buzzword Roth, what everybody talks about, is like the one you want, especially if you're young. Roth IRA works, it's still your individual retirement account, but the money is not pre-tax, it's post-tax, meaning you don't get a tax deduction. This is money that is straight out of your pocket, your wallet, your bank account, your under your mattress, wherever. That's money that's already been taxed. If you have it, it's already been taxed. And when you put this money in, you don't get a tax deduction up front. But when you take it out, it doesn't matter, when you're old and you take this money out, you pay no taxes. So that's why a Roth IRA is awesome. All IRAs and 401ks are tax deferred, meaning you can buy and sell securities throughout all these years, and you won't have to worry about paying any taxes. You only pay taxes on the amount when you withdraw. Roth IRA, 0 taxes. So, do you have any IRAs?
I do, yeah. I can contribute up to like $7,500 a year.
Yeah.
I've been contributing the last 3 years, so I'm kind of on the tail end of it. But I do have a traditional IRA and 401k. So
yeah.
But to James's point, if you start like contributing to a Roth IRA at like 21, right when you get your first job, that's huge because you're collecting interest over every month off of it, and it's tax deferred when you retire. So, and there's limits for each year, obviously depending on age, your job profile, and once you keep contributing, you can contribute up to like, I think, what was the limit?
Yeah, $7,000 a year.
$7,000 a year. So,
and that's combined between both. So if you were going to contribute to traditional or Roth, $7,000 combined. But if you're young, you should really only be contributing to your Roth, unless you were in some kind of tax scenario where you needed a tax deduction, then you can contribute to a traditional. But otherwise, you should put it in towards the Roth. So we talked. 7,000 contribution limit for IRA, and then 401k has a contribution limit now in 2025 of $23,500.
Wow, that's
huge.
That's huge.
And then combined with the portion that your employer contributes, you can have a combined contribution limit of $70K in a year, which is huge. It's massive, and because a lot of companies like the company that I work for now allows your contributions to be considered Roth contributions if you want, which is awesome because then eventually when I leave that company or retire, those that are considered Roth contributions will go into my Roth IRA, which won't be taxed when I take it out. You want to get as much money into Roth, what would you call it, classification as possible, because any money in the Roth
is tax deferred, guys, when you retire.
Tax free when you take it out.
Tax free. It's not deferred. It's tax free.
That's amazing.
That. And it's not. Won't be taxed like earned income. Won't be taxed like capital gains, 15%. That's huge when you retire. Yeah. And it's liquid. It's like you can get out of it when you retire. Say he's 59, 62, whenever the retirement age is. And like think about how much like $7,000 a year is. Like, that's manageable. That's something that's like a goal that you can attain every year, to put aside $7,000. Instead of going on vacation for say 1 year, you could use that for your Roth IRA. In like 30 years down the line, you'll be thinking to yourself, wow, I set myself up for success because I didn't take that second vacation to the Bahamas and spend $10K. So it's a goal, and the reason why there's a limit,
or Coachella,
or Coachella, right? You're spending $7,000 to get bake in the sun in the middle of the desert with people, strangers. So
drugs,
ecstasy, whatever you want, whatever gets you going. So, but those are huge key points.
It's so important, and like you were saying, if you start young too, because actually that's exactly what I did. I remember when I was in my senior year of college, I opened up a Roth IRA. I started contributing. If you contribute the max, like $7,000 a year, which I think when I started it was like $4,500 or $5,000. If you contribute, and it's not that much money, it's like a few $100s a month. If you start when you're 21, 22, but by the time before you're 30, you're gonna have a couple $100,000 in there. That's just how quickly this compounds and adds up. So definitely, I would make that top priority, and certainly if you're in your 30s and 40s, that advice still holds true, and even more so because you don't want to be in your 40s, 50s just starting to think about retirement, because that's not going to be a good time.
Yeah, it's the old saying, like, you know, if you talk to the Ray Dalios of the world and investors like that, they'll 100% they would say, what's the first step is contribute to Roth IRAs. Then from there, when you gain more expertise, you can short stocks, you can go long stocks, have your own trading account, your own brokerage account. You can learn from there. But like the first step is in basic finance is contribute to the Roth IRA, match your 401k if your employer gives it to you, and that's like the first base. Second base is now setting up your own brokerage account, learning how to trade stocks.
Right, that's a good point. There's like a priority, right? So first I would say, well, obviously you want to be matching whatever your employer matches in your 401k. If it's like 3%, 5%, I had a company that was like 17 when they give you a 10% bonus at the end. But whatever your company is matching, usually it's 5%. You want to make sure your contributions for 401k are set up to at least match what they're contributing. So 5%. That's number one. Number two is with the IRA, you want to try to max out your Roth IRA contributions, $7,000 a year. And then after that, you want to be investing into your brokerage or non-retirement account. And hopefully the more money you make, you'll be able to start pumping a lot of money into that brokerage account. I know me personally, I started actually pumping more into my brokerage account. And when you get to a certain point too, this is the one kind of crappy thing, is that the IRS actually has income limits for contributions to Roth IRAs. So after you make $150,000 with your MAGI, your modified adjusted gross income, you can make a partial contribution. And this year, after you hit 165 of income, you can't make any more contributions to your Roth IRA. So try to get as much as you can in those early years, meaning your 20s and 30s, because maybe soon you'll be over that income limit and won't be able to contribute anymore. But there is workarounds, right? Like you can still contribute a lot more to your 401k.
Yeah.
And although you don't, because 401ks, you don't get to trade whatever you want, like IRAs and your own individual brokerage accounts, because it's under your employer's plan, so they usually have rules. But there's always like some, a basic index fund you can get into, like S&P 500, small cap, large cap, whatever.
Yeah.
So do that. But you could, since the 401k contribution limit is much higher and there's no income restrictions, once you leave that job, or it depends, maybe even while you're there, it depends on the rules of your plan, you can actually roll that money into your own personal IRA. So there's always a workaround, backdoor. You can do a conversion from traditional to Roth. There's always like a little workaround. So when you start, making more money, you have to, I guess, deal with those problems at that point. But bottom line is just get the money in the market and keep contributing, especially during these dips. That's when you really gotta, full force and start. You gotta take the fear away. Now if you're like 80 years old,
yeah,
this advice maybe wouldn't apply, because you're at that stage in your life, you should be using the money that you saved up all these years, right? You don't want to be worrying about investing at that point. But when you're young, anything under 60, really. My mother just turned 70, and I still tell her, no, like, forget bonds, just stay aggressive in stocks, because you got plenty of time. If the market dips, it comes back in what, like like 5 years, the Great
Yeah,
Recession or whatever. So I wouldn't be worrying about selling everything until I'm like in my 70s, 80s.
Yeah. So I hope this episode was insightful. We want to give you more.
Oh, one more
insight.
before we end. Should we just mention the tariffs?
Yeah, and we're gonna talk about tariffs because we want to make like relevant points of what's happening in the economy now.
Yeah, again, back to like what we were talking about when the market rebounding. I know one fear was the tariffs were going to cause inflation, and that was going to cause our rate cuts to slow down, and we might even have to, raise rates or anything. But the tariffs so far have shown virtually no inflation.
Yeah,
we're still in the
inflation,
downtrend
guys.
for inflation.
Yeah, we're still and oil prices have gone down, inflation's down, and we're still like Trump's imposing 20% tariffs on Vietnam under the trade deal deadline July 9th. So if inflation doesn't go up after that, then I think there's there's evidence to say that maybe the economy with less globalization has not caused inflation, which will make more companies onshore to the U.S. It's a really interesting dynamic. You would think like inflation would pick up with companies getting hit with tariffs and just the different dynamics of how money flows in markets and whatnot. So that's the reality on the ground. We want to bring that to you because inflation's sitting at what, 2.8 right now?
Yeah, we can put a chart up on the screen here of the inflation, and you can see that. Well, when we first started raising rates, it went down a lot, but it also went up crazy before that. But over the last few months, it's been on a steady downtrend, and we continue to. I mean, you're going to see small little ups and downs like that on the way, but we're still within that downtrend. Nothing out of the unusual, and yeah, I mean, tariffs by nature should be a one-time increase, but we barely even saw that because
we didn't see anything.
Well, we're still in a restrictive rate environment, so that's also downward pressure on inflation, and also tariffs want to incentivize more of buying within America domestically, which typically those products would cost a little bit more than the Chinese products. So that right there is also, I would argue that it's deflationary because of it is like a smaller, higher cost that we now have to switch to buying more American. There is those tariffs on some products. That in itself, I would say lowers demand a little bit. I mean, maybe not like and see in the beginning we thought it was going to be the opposite because everyone was going crazy buying stuff. Oh, we're going to buy some before the tariffs go up. And like we mentioned, like Apple bought a ton of phones, shipped them over. But I think it kind of proved to be nothing almost. People are just like worried. It's like people on Black Friday. Oh, I'm gonna buy it right now. It's on sale. But it didn't really prove to be much of anything. And I think these tariffs so far have been non-inflationary. Essentially, is what the data has been showing.
Yeah, that's what the data is. 2.4% is what inflation is. The previous was 2.3, but with all that commotion and with like how big the tariff numbers are, that 2.4% should be sitting at like 4.5%, like that differential, and that's not what we're seeing, guys. So it's really, I feel like. Don't take the expert's opinion as a grain of salt. The experts, like listening to us and getting our thought processes and feedback, it goes a long way. If you get multiple people's viewpoint, because when you look at the data on the back end and you let emotions kind of take over, and the experts, they know what's going to happen, but the results are that inflation's been low. It's actually has been low. So. The whole supply side economics, and you get into all these professors of different economic models. At the end of the day, the reality and the results are going to show how inflation is measured, because it's such a. I know inflation is one word. It's one definition, but it's so dynamic. There's so many different
Yeah.
moving parts to it.
Yeah, we could do a whole episode on inflation. You know, we should do that. I want to make some long-term graphs of inflations and try to map it to other data. Yeah.
We're definitely going to do that for you guys, and it's inflation's like it hits. I think it's the most relevant thing as a middle class or lower income people, because when you go to grab a coffee, it's like, oh, this coffee's $4. How did that happen?
A lot of people define it in like so many different ways too, and like what is inflation? I mean, it's at the end of the day, it's really just prices going up. That's there's many different reasons why they went up, but that's what inflation is essentially. With that being said, that's going to end episode 9. We're going to start episode 10 in a couple of weeks or even sooner. And we're going to bring you guys more insight with Tropic Trading. So yeah,
stay
we're a little bit
tuned.
under construction right now. If you notice, we got the green screen going on. So hopefully we can make something happen here. And if not, you'll just be looking at this green blanket behind us. But it's all part of the process.
It's all part of the process, guys. We're going to make this channel grow, and you're going to be on the ride with us. So.
Yeah, exactly. Well, thanks for another episode, and we'll see you all soon.
See you guys soon.
All right.
You got it?
Please tell me we got that.